Correlation is a statistical measure that shows how two different assets move in relation to one another. Let us break down how this works. At its core, correlation describes the relationship between two investments. When one goes up, does the other tend to follow or move away? The coefficient ranges from -1 to +1. A value of 1 means they move in perfect lockstep, while -1 means opposite directions. Positive correlation happens when assets rise and fall together. Negative correlation is key for diversification, as assets move in opposite directions. Remember that correlation is not causation. Just because two things move together does not mean one is the direct cause of the other. This chart shows how different asset classes relate. Gold often has a negative correlation with the dollar, which is why it is used as a hedge. Nobel laureate Harry Markowitz noted that diversification is the only free lunch, and understanding correlation is how you build a truly diversified portfolio. Understanding these patterns helps you manage risk. Subscribe for more basics, and remember that this is educational content, not financial advice.